Okay, folks, Happy New Year. Great to see all of you. I think we have a good number of people here, so we're going to get started. So, we have had an exciting roller coaster in the markets, and we're at a good place now. For a while there, the stock markets, bond markets, they were kind of both lagging, and now we're in a position where things are looking up, and it's been a good time right now. We see a lot of easy cash. Money is basically risk free, is getting you over 5%. So it's a good time. But the question is, how long will this party last? What do we expect to happen this year? And what's going on with the various industries and the various asset classes, and are there any benefits to be had in any of them? So that's one thing that I'm going to focus on. So here we go. I'm going to launch into the presentation, and I'm going to share screen now. Share screen, and here we go. So you should be able to see my screen. And like I was promising earlier, we mostly have pictures, so not to worry. So this is the 2024 market forecast, to the extent that one can forecast any markets. And we're also going to look, like I mentioned, at the best asset classes to invest in. And I know we have some new folks. For those of you who don't know me, my name is Toni DasGupta. I have an investment advisory, Veda Financial. We're on the Schwab platform. And if you know me, then I'm really very passionate about particularly the public markets, and love learning about it. I think it's endlessly fascinating, a lot of data, and for ex-physicists like me, that's really a lot of fun. So the one good interesting thing happened in 2024. I was certainly always been doing the investment management with Veda, but now we have increased our team, and we have at a point where we're doing a little more holistic wealth management, which is estate planning, financial planning, tax planning, all of the everyday stuff that you need to do. So that's what's going on with us in Veda and the new developments. So the interesting thing is the key economic themes of 2023. Well, like I said, the good news is we had robust post-pandemic rebound, some ups and downs, but pretty strong rebound. And there have been inflation concerns. Prices are rising, which is, of significance to a big part of the population, most people. And then there are also like tighter monetary policies which have gone into place, so which we'll talk about a little bit more. Digital transformation, can't get away without talking about AI and the transformation it's going to bring. And it's interesting what it's going to do to the investment market, because right now, to be very honest, we don't know. We think we have to kind of be a little bit cautious, but certainly AI is not going away. I mean, actually has been with us for how long? Like, I would say like from the 60s. And, so it's not something new, but I think we're seeing a lot more applications of AI in different industries. And that's what's exciting. Green transition, sustainability is still a hot topic. We're going to see more of that. Sorry. Okay. And then geopolitical risks, wars here, there, Ukraine, and Israel, that's a concern. So that's something to keep on top of. Not much we can do about that, but something to be aware of. Okay, so this is a quick one. Inflation still elevated but falling. So that's the good news. It is coming down. As of today, I think the inflation number is 3.4%. So given where we were a little while ago, okay, so where is the US? That's the deep blue. I mean, inflation rates had gotten pretty high, and the fact that we're even as low as we are right now is a very good sign. Ideally we want it to be close to 2%, but I think we're like very close to it. So I think that's been a very interesting tightrope walking by the Fed, because they have like two jobs. They have to keep the country working, but at the same time they have to reduce inflation, and the two can be at odds with each other. So guess what they did? They managed to walk the tightrope. I'll say that so far looks to me successful. Would love to get your all of your thoughts on this later. But I believe we're at a good place where inflation is getting tamed without a recession setting in. And a couple of years ago, I mean, I had a client saying, I want to take out all of my money and put it in cash because a recession is coming. And that was actually a good 5 years ago. And, as often, if you've seen these things a few times, you kind of go like, okay, if a recession is coming, there's certain steps you're going to take, but let's not, and predict. So none of this is supposed to be a prediction. We don't know what will happen next. What we can do is look at the probabilities. I think that's probably the best we can do. So, so what is the Fed going to do? It's like become our favorite game, right? What are they going to do next? Well, we have some inkling, but let's see where they were. And this is like a really long time scale from 1870 until today. And that this little inset is, so basically interest rates, the Fed long-term rates have been bouncing between 3% to 6% for a big part of our history. But you see how it got closer to zero almost. I mean, a few years ago, we're like, how do you even make money? Where do you get yield? What do people who need income want their money to make money? What are they going to do? Because, getting fixed income used to be such a sure thing, and it wasn't anymore when you're close to 0% interest rates. Money becomes cheap, but on the other hand, you don't get any money from investing, particularly into fixed income products. So from there, we've rebounded quite a bit. So the Fed's rate right now is 5.25%. We believe that they probably won't do too much about dropping the rates maybe end of January. We don't know, but probably not. But by March, it's generally anticipated that there will be interest rate reductions, interest rate cuts, which is good for people like, for example, for industry. It's going to be great. So that's one thing to watch out for as to how this impacts companies. So what has been the economic outlook right now? Basically, it's been consumer driven. The consumer is still, believe it or not, they're still working and they have good amount of money in their pockets and they're spending. And that is the single factor that has made the markets stay very strong. And that's what's fueled the economy or fueled even the lack of a recession. So we're in a good place in that fashion. There is a deficit, sure, but it's not the first time we've run a high deficit. So take it for what it is. We expect that the yields will come down to 3.5% to 5.5%, which is kind of historically, where we think they would end up anyway. But the point that I want to draw your attention to is consumer resilience. The consumer has been very resilient, and do we know what will happen in 2024? But we expect at this point continued economic growth. There's not a catalyst that's going to make it go the other way, other than something crazy happening with wars or something. So that is kind of what the expectation is. The consumer stays resilient and economic growth continues. So the rolling recession. So, this is a new cocktail term, like kind of word that you can drop at the next party, is the rolling recession. What is the rolling recession? We never saw a recession, but then people say, well, certain industries had a recession. If you remember housing has been kind of really hard hit. This is basically the Case-Shiller home price index and how that's gotten beaten down quite a bit. So housing has seen quite a recession. But the recessions, why they call them rolling, is they've happened at different times for different reasons. Travel, COVID got hit badly. but then rebounded nicely, bounced around for a while, and now it's getting higher. And if you've been traveling, you see that, right? And then oil, again, when we stopped driving in 2020, oil got beat up. From since then, it's rebounded very nicely. And oil has been actually one of the, even I hate to say it, but even in California, oil has been like a very fairly strong, sector of the economy. Semiconductors, so the semiconductors again got beat up at a different time in 2022, and that was because of supply chain issues, basically trade political issues, and that came down. But look at how semiconductors has rebounded. So semiconductors is very strong, and that market has seen a lot of gains. So that's kind of where we are with the rolling recessions. So what is the potential growth outlook for 2024? Well, the thought is that we'll see an economy that's growing at a reasonably decent 2% annualized in 2024. And mainly, people are more or less in agreement that the possibility of a severe downturn and recession is seeming less than 50% or much less than 50%, depending upon who you talk to. So there are not going to be a lot of people who are going to be saying that, oh, I see a recession coming. There'll be some concern that it could, but whatever it is, I think the thought is we're achieving the quoted soft landing, where we have inflation coming down, interest rates going up and then coming down, but we managed to avoid a severe recession. So I think that's an amazing achievement, I feel. I don't know whether to give the credit all to the Fed or not, but it certainly is an interesting time in economic history, I think. So what is looking good so far? Corporate earnings are expected to rebound. Corporate earnings, if companies make more money, their earnings are better, they're generally paying it out to shareholders in some fashion or growing. So all good stuff. The expectation in the US is corporate earnings to actually go up dramatic 11%. But the part that I want to bring your attention to is there are the international markets. The developed markets next year, we're expecting 2024, 6%. But look at emerging markets. That's like a whopping 18%. And given how beaten up was it, because if you remember 6 months ago, whoever attended, hopefully you remember this, I said, let's not discount emerging markets. They're beginning to look interesting. And here we are, since then I have been keeping track of the emerging markets. And I think the growth trajectory is very strong in many of the markets, not all, of course. And I'm just going to show you another slide, which will tell you like who's growing, who's not. So it's basically what I told you. What happens when there is an earnings rebound? That has the possibility of driving stock prices higher, because what are stock prices? They're just what valuation you put on companies, and the valuation of the companies grows as corporate earnings grow. So there would be an expectation that earnings would rebound in 2024, and it would drive the stock prices higher. So that's one positive catalyst that we're looking at. Then, so remember, if some of you were there in the last talk too, I said, no holding cash. Please don't hold cash. You're getting 5% on cash for taking no risk. Let's find places to invest our cash. So what we did, most of us were putting it in money markets, and which were producing a lot of money, or treasuries. Treasuries were doing well too. So we're at an interesting inflection point. Remember the easy money of treasuries? What happens when the rates start going down? The treasuries the yield is going to start going down. And you know what happens when some bond yields go down? The prices in the market, so basically the opposite will happen, because you're in a higher yield. But basically in time, as you get your treasuries are maturing, what are you going to do? You're replacing with cheaper and cheaper ones with less yield. So we'll look at which parts of the bond market look interesting, but here is kind of what we expect. Now, historically, somebody's always looked at everything there's to look at. And after Fed hikes have ended, typically stocks and bonds have outpaced cash, meaning that they're generating positive returns. But it's interesting how dramatic it can be. So, so this is basically cash equivalents. And we're seeing that, it's closer to 5%, like 4.7% following a Fed hike, 1 year following a Fed hike. And, but then, of course, that goes away over time. It kind of peters out. It's kind of rowdy. For core bonds, so basically for a basic bond portfolio, you're going to have 10% versus 7% in the 5 years following the hikes. And US stocks also have traditionally done very well. And this is just a blend of these two. So it's interesting. I think it's some cause for having something to look ahead at. So so seizing investment opportunities, the Fed's aggressive rate hiking, continued and made money attractive yields on the money market funds, but that's, like I said, it's not going to probably last very much longer. We expect that there'll be rate decreases, if not in January, maybe starting in March Fed meeting. And so this is at a point where the cusp of a major transition and something to watch. And this is the time to kind of also make sure our stock and bond portfolios are strong. I mean, this is something I look at every day to see, how we're going to move between cash, stock, and bonds. And there are good reasons for both. Of course, I'm not talking about every portfolio, tend to have people who are like retirees or people who are starting out in their career, very different kind of portfolios. But generally, you're looking at a mix of these asset classes. And this is a point where, we're kind of making another transition. So that's something to also put some thought in. And of course, what would we be without, a discussion on artificial intelligence? So artificial intelligence has different pieces of it, but, the challenge is going to be to separate, like they say, the hype from the real opportunity, because the pockets are, the straight players in cloud computing and AI software, all these big, Microsoft, practically owning a lot of AI. And then the applications in tech and telecom, finance, there's practically applications in every industry you can think of, even the ones which are very non-tech. And that's the thing, it's basically transforming everything. But question is, where do you put the investment? Into the company that's making the AI, or put it in where the applications are? So, we'll take a look at that. Then the pure players, semiconductor, chips, like NVIDIA, and so on, those companies, so which of course are doing very well from this resurgence. I don't know, this is where I think I need to make a disclosure. We hold stock in both NVIDIA and Microsoft, so take everything with a grain of salt at least. So AI market, it's getting a lot of attention. I don't know if you folks have heard about the Magnificent Seven. These are the 7 big tech stocks, Apple, NVIDIA, Microsoft, the 7 big stocks, Amazon, which it's in a point where out of the S&P 500, the top 7 are heavily weighting the whole performance of the S&P 500 or, the NASDAQ. And they're fueling a lot of the growth. But then, you ask, well, what's happening to the other 493 stocks in that universe? And I'm sure there's some very good companies that have gotten beaten down because they're not getting so much attention and have good valuations. But meanwhile, these are the ones that have been kind of fueling this whole growth, particularly in the NASDAQ. So so basically, that's the big 7 companies that are getting the most attention. But beyond the tech world, there are a lot of companies that are using AI, like McDonald's. Basically, you can go order a burger, and you can even ask, like, human questions with ChatGPT and chatbots and all. They'll try to figure out what your issue is, try to resolve it, and all kinds of good things. So I think that's like an amazing development. And then JP Morgan, banks using it to detect fraud, things like that. So I think the number of applications is going to be whatever you can imagine. But the thing is, deciding on where to make the investments, that's the bigger challenge. So the way we've been looking at it is, it's too early to play in a single AI company that is especially early stage. Right now, the market is not rewarding high risk small companies. But in that case, if one wants to participate, a better way to participate in this is through like an exchange traded fund, or going with the larger, better known companies. Although many of them are very overvalued at this point. So those are the two ways to do it. Probably going with individual small companies, and it's the risk is going to be higher unless you're buying a whole basket of them. So, and then finally, this just something I just threw up there. Emerging markets are definitely up, like I showed you before. India is doing very well indeed. The returns post-COVID, India's up, Mexico's up. China, though, is beaten down. We can say China has good valuations, but China has. I don't know if you all heard about this. Apparently, Chinese women are getting texts these days from the government saying it's time to have another child. And who would have thought that would anybody, like, the Chinese government would be doing that? So that's so China has like different issues, weak consumer spending and so on, and a real estate crisis. But on the other hand, Japan and India and Mexico have seen strong rallies. Particularly the India market is very interesting. The growth has been aided by government and like infrastructure spending. So it's been an interesting story, particularly over the past year. So let's see. Yeah, so basically, just what I told you, getting beyond China's shadow for the emerging markets. And I'm going to skip the corporate. In the bond side, just pointing out, although we expect like treasuries are not going to be, it could be less interesting as the interest rates come down. Investment grade corporate debt is expected to have good growth. And that's something we're looking at very closely because, in the fixed income world, you're kind of going to do a changeover at some point, also in the stock world, but particularly in the fixed income world. And finally, where to go when the music, the easy yield stops. Same thing with mortgage. There are mortgage-backed securities, which are securitized homes into basically into securities so they can be traded. This is one place people are looking at because they expect that the real estate cycle to get stronger and housing demand to grow. So that's one place. And then, like I mentioned, investment grade corporate bonds, companies floating bonds and decent coupon rates because they're sitting on a lot of cash, strong balance sheets, and that's what's probably going to make it go. So my last slide, which is, so how exactly do you position your portfolio for a range of objectives? We'll look at people who are want aggressive growth all the way to somebody who wants income or moderate growth and so on. So every person's portfolio is going to be different, and what you choose for your portfolio, I'm sure, would be different. The parts that I would point out is consider putting some non-equity exposure in there. It's also good for diversification. And I'll say even we have been so more focused on US equity because that was by far the best market, but it's a good time to look at some diversification and being flexible. I just highlighted flexible. things are not going to be easy. Besides, it's an election year, but that's a different story. We'll attack that next time. How to invest in invest in an election cycle, and so there are pockets. AI is certainly a good opportunity. Um, so this is the conclusions. Whoops. Okay. No, these are not from six. Oops, sorry. These are not from 623. I didn't update it, but I was going to show you that some of the conclusions are the same. We have a good global recovery going after the stopping of the interest rate hikes. Stocks and bonds are expected to outperform, I should say. AI will continue to transform, but be careful. Transition time in rate hikes, when rate hikes go from increasing and then they start decreasing, it's a good time. Opportunities in stocks, also bonds actually. Looking at yields on the corporate side rather than on the treasury side right now. And then looking at opportunity in non-US equities. That's like the big conclusion. So in conclusion, let's maintain diversified portfolios and stay flexible. So with that, I'm going to, that's just the next one. I thought it'd be like kind of fun to throw that up. I'm going to go back to, I'm just going to close the presentation here. And let me put it in gallery view. Okay. So let's see. Anybody have any questions? Please feel free to turn on your microphones or put it on the chat. Let me know. Somebody's got to have a question. Hi, Ike. I see you now. Sorry, I didn't get to. Hello, Amod. Yes, we got. So if anyone has any questions, please yell them out. So what do you all think? Does anyone have any thoughts?
Hi, Toni. I wanted to respond to you. First time I'm here, just listening in what you've got going. So thank you for the presentation. Very much in line with your thoughts and what you shared. We obviously operate in the same, not only in your business, but in cybersecurity, fraud, mortgage-backed securities, real estate investments, payment solutions, and so on. So thank you for the information, and I'm pretty much on the same page. Very informative. Thank you.
Thanks, Ike. I think, yeah, so the question, oh, sorry, Amod, that you aren't able to get your microphone isn't working, but feel free to type in a question if you have. And Beena, hi, Beena. Is it safe to leave in bond, money market, and what percentage in emerging and AI? So the recommendations for emerging markets is, we don't want to grow it like right away, but looking back to an allocation of 15 to 20% is reasonable, but sort of working back into it, because right now we're all kind of been more heavily in equities. And to leaving the money and money market at this point, we'll see when the rates turn, but money market is not going to, my estimate is money market rates are at the end of 2024 are going to be quite a bit different from the start of 2024. So right now we're still at 5% plus. So yeah, it's good. Hi, Kushi. Regarding any recommendation for mutual fund and individual stocks, well, I don't normally try not to give individual recommendations, but I do discuss them from time to time on the newsletter. I would say that right now, more than individual stocks, particularly if you're like, I don't know what level you're at, seasoned or starting out, I think the best thing is to look at exchange traded funds more. There's like mutual funds, but a lower cost ratio, and you have diversification because they're a basket of stocks. You look in particular industries or sectors, like say for AI, you would look at it as an industry. or in energy, you would look at it as a sector, and there are those sector exchange traded funds. But you can, just message me. You have my information. Message me if you have any questions. Anybody else? So I think we got through that. Well, everybody, thank you so much for attending. Really appreciate it. And I was just wondering, I wanted to put a poll. I'm probably going to do this every other month, maybe once a quarter. I don't know if that's too much or too little, but hope to see you again soon. And if you have any thoughts and any ideas for improvement, definitely let me know. Thank you so much for coming. Appreciate it. Have a great year.
Thanks, Toni.
Thank you, Toni.